Hi everyone! With Zoom Video Communications, ticker symbol ZM, reporting earnings after the close today, we thought we'd do a stock analysis video on this high growth business and drill down on valuation, their growth prospects, and what we can expect with today's earnings announcement. Welcome to YCG, where we help your capital grow so you can achieve your financial goals. If that's something that interests you, then hit that subscribe button and the bell notification so that you don't miss a thing. I'm Will Kruger, CEO here at YCG. So this video on Zoom shouldn't be considered a recommendation to buy or sell the stock, but we hope as we evaluate this company that for educational purposes, you'll understand a little bit better about how we think and understand the investment framework that we use here at YCG. Zoom has quickly become a household name because of the COVID-19 pandemic. As the world began to shut down in-person business in March of 2020, it was the ideal introduction for Zoom and its services to help individuals and businesses connect virtually and to continue that social interaction that humans crave. The company IPO'd in April of 2019. If you're not one of those social creatures or haven't heard of Zoom, let me briefly explain what it is. Zoom is a provider of video-first communication platform and web conferencing services. It offers a cloud-native platform which unifies cloud video conferencing, online meetings, group messaging, and a software-based conference room systems, which enables users to easily experience Zoom meetings in their physical meeting spaces. Its cloud video conferencing solutions include full screen and gallery view and dual stream for dual screen. Its security solutions include secure socket layer encryption and role-based access control. It offers its solutions to education, finance, government, and many other sectors of the market. The company's operating segments include the Americas, Europe, Middle East, and Africa, and also Asia Pacific. So video conferencing software has been around for a very long time, with competitors providing similar services like Google Meet, Microsoft Teams, LogMeIn's GoToMeeting, etc. So how has Zoom been able to dominate in this market segment? Well, video conferencing in the past was clunky, slow, and pretty much of low quality. Zoom offers a disruptive technology that was designed from the ground up as a video-first collaboration platform and focused on video conferencing as its primary service. Coupled with a forced-to-work-at-home pandemic and gave rise to a global social network where it became the software of choice for video connection for personal and commercial use due to the higher-than-average customer satisfaction. So with that, let's switch over to Refinitiv and look at Zoom from a quantitative side of things. This is just really a basic analysis of Zoom. Unfortunately, we don't have enough time to cover the kind of depth we go into before deciding whether it's a stock suitable for client portfolios. Okay, let's jump into Refinitiv then. Okay, here we have Zoom, ticker symbol ZM, trading at around $331 a share. About 2.7 million shares have traded in today's volume. Company is headquartered in San Jose, California, with about 4,400 employees. Let's look at their capital structure. Their balance sheet, very strong as far as cash goes, and that's what you want to see with a technology company. About $2.2 billion in cash and cash equivalents. No debt. Let's take a look at some of their key ratios. So if you look at their enterprise value to revenue, trading at about 39 times last year, this year forecasted to trade around about 25 times. Looking at their PE, so this is one of the negatives about the stock is just the lofty valuation. So from a price to earnings perspective, last year was trading at 165 times. Looking at this year's full year forecast, trading at about 88 times. And going into 2022, trading at around 82 times. One of the positives about the business is very capital light. So returns on assets have historically, well, at least last year, dramatically increased to about 20%. This year forecasted to be about 13.7% returns on assets. Return on invested capital looking to be very strong, around 55%. this year. So let's take a look at the stock. So the stock from the high, trading at around $570 back in November of 2020. Ever since then, the stock has really been on a negative decline, trading at 331. So it's been about a 40% decline from the high of Zoom back at the end of last year. Not a lot of short interest at around about 3%. Okay, so let's take a look at the price to earnings multiple. Here we can see some price and chart action. And this is what I was talking about as far as the highs and lows. You can see here the last versus the high decline since the 19th of October of 2020 was the high. And since then it's down 43.7% with the stock price. So huge decline with Zoom. And let's take a look at the numbers and expectations as far as the earnings are concerned. Here now, if we take a look at the financial summary, you can see that revenue as of last year came in around $2.6 billion. This next year's forecast is projecting the company to earn about $3.8 billion in revenue, and in 2022 growing to $4.5 billion, and then in 2023 about $5.3 billion. One of the things, as you know, if you watch our stock analysis videos, the thing that we really like to look at here is gross margins. And gross margins historically last year have been about 69%. It's forecasted to be this year around 70%. So very high gross margins, and that shows that they have pricing power, that they can continue to raise their prices. The question is, will it be enduring, and will they be able to stave off competitors and peers coming in and gobbling up that profits to be taken within the industry? You can take a look here that EPS growth, earnings per share, been about $2.25. It's forecasted to be about $3.76 this year. And let's actually take a look at the earnings right here. So here you can see the earnings here in 2021, just a banner year. And here, if we take a look at our EPS growth chart here and change the EPS to Q1 of April 2021, you can see that this afternoon's estimate is coming in around 99 cents as far as earnings per share. We'll have to see what the company reports today, but everyone is looking at that. Will the company continue this decline in its price action, or will there be a surprise from an earnings standpoint above the 99 cents that's expected? And we'll have to see. So coming back here to the chart, you can see this massive growth in earnings. The question is, will it be enduring, and can they continue to grow revenues and earnings? One would expect that over time, they're going to have to spend a lot more money in innovating and creating new products. And will that affect profitability? And that's a question that is yet to be answered. Top investors right now, kind of the big, large institutional money managers with T. Rowe Price, Vanguard, Morgan Stanley, BlackRock. What we do like about the employees and directors and officers of the company, Eric Yuan is still the chairman of the board. He's the founder and still leading the company and innovating at the company, which is always a very positive thing. Interesting that Refinitiv puts Facebook and Amazon as peers, and just incredible the size of Facebook and Amazon here. Amazon being 1.6 trillion, generating $419 billion in revenue in the last 12 months, relative to Zoom's 2.65 billion. So obviously, relative to Amazon or Facebook, very tiny, but from a valuation standpoint, very expensive, right? So looking at enterprise value over EBITDA, next year's EBITDA, trading at around 73.8 times relative to Facebook at 14 times and 20 times with Amazon.com. If you want to learn more about our entire investment strategy framework, we have a video for that, and you can check out this link up here. One of the challenges facing Zoom is executing across so many different aspects of growth simultaneously and maintaining that competitive advantage that was so apparent as we looked at the numbers. With most technology companies, you have to always maintain your competitive advantage through innovation, and Zoom is trying to do that, for example, with Zoom Phone. But this is a much more complex sale. Its largest competitors are Cisco and Microsoft, who have dominated the video conferencing market and can provide a bundle of services that will entice larger customers to remain or potentially switch over and away from Zoom. I think what would be helpful at this point is to look at the Refinitiv quantitative numbers again, but to put them through our YCG investment framework. Okay, so let's take you through our stock analysis, looking at the qualitative and quantitative analysis through YCG's investment framework here. So clearly a competitive advantage for Zoom is they are the technology leader in video conferencing category. That's pretty clear. Is there a strong network effect? And we would say no from that perspective. Is it a global one? Yes. High switching costs is a big concern for us just because there is such a low switching cost with regards to using another platform or service. So enduring pricing power, there clearly is pricing power right now as demonstrated by the high gross margins, but the key word is enduring. And our belief is that as more entrants come into the market with the more commodity-like type of service in video conferencing, that profitability will likely come down. So from an enduring pricing power standpoint, we'd have to say no from that standpoint. Morningstar gives it a none rating as far as moats. Capital allocation is standard. So the fair value uncertainty, because of that low switching cost and no moat, is rated at a very high. Category is large cap growth. So let's take a look at the Refinitiv numbers that we just looked at and highlight some of these things. So the trailing 12-month gross margins, about 70%, so clearly has massive amounts of pricing power. Estimated gross margins around the same, about 70%. The trailing 12-month operating margins have been very high at about 25%. Returns on capital employed at 27%. Returns on invested capital at 27%. ROTAs, so return on tangible assets, so again, it's a very capital-light business, around giving you about a 20% return on tangible assets. And your expected return on equity is around about 29%. Like I said, very strong balance sheet with net cash, which is great to see. So no debt, a lot of cash on the balance sheet, and currently total enterprise value of about $104 billion. With next year's revenue estimated to be about $3.8 billion. From a valuation standpoint, and this is one of our issues with the stock, is just the high and lofty valuation. So enterprise value over next year's full year sales, about 27 times. The price over next 12 months earnings is about 86 times. And then when you actually look at the enterprise value over next year's earnings before interest and taxes, it's trading at a lofty 111.4 times. So would YCG consider this as an investment? I think as of right now, no, just because of there's just no moat and the high valuation with the business. So let's take a look at a competitor. So Microsoft. Let's for instance take a look at the shareholder yield and growth rates. This is something that we look at a lot here at YCG, and this is a very simple analysis. But here you take the price of Zoom at $331. We're being very generous with our EPS, so about $4 a share. Obviously, if they spend more on Zoom Phone, those earnings, that cash flow available to be passed on to shareholders could be significantly impaired. Perhaps acquisitions come in the future that dilutes that as well. We're being pretty generous with the percentage payout, but again, it's a very capital-light business, so we're listing that at 90%. So let's adjust that shareholder yield and say, all right, the company will generate about $3.60, which gives about a free cash flow yield of about 1.1%. It's a very high-growing company, so we're being very conservative on the growth number. But if you tack that on a 5% growth, your forward rate of return is about 6.1%. much more on the growth side versus on the cash and the value side. Now let's compare that to Microsoft. Microsoft trading at $249.68. Its earnings per share going out on average about $8.35. We've said, again, it's a very capital-light business, so to make that apples to apples comparison, we're saying a 90% payout. Gives you a shareholder yield of $7.52, a much higher free cash flow yield of 3%. And again, if you tack on a 5% growth number, your forward rate of return is at about 8%. So much higher than Zoom's shareholder and the free cash flow payout just being a lot more dominant and a lot more consistent from that standpoint. We frequently discuss our desire to own businesses that participate in inflationary rather than deflationary categories, such as selling computers and TVs, which have dramatically decreased in price over time. You could probably include video conferencing technology in that bucket. In our opinion, Zoom has an incredibly lofty valuation, trading at 111 times with regards to their enterprise value over its next year's earnings before interest and taxes. It clearly has demonstrated pricing power and is a beautiful capital-light business as demonstrated by its high gross margins. But with no moat and a plethora of other viable software solutions, and with more competitors coming to the market to participate in that profitability, can Zoom in its long runway for growth maintain its pricing power? Video conferencing is a business commodity, and with most commodities, we've seen an erosion of its pricing power over the long term. Can Zoom transform and adapt, introducing new services, keep its competitors and peers at bay? I guess we'll have to see. And now with the United States of America reopening and recovering from the COVID-19 pandemic, will consumers opt to interact in person rather than virtual means? And what will that mean for Zoom's business? Clearly, we've learned how to conduct business virtually, and that's not going to go away altogether. With a new head of sales at Zoom and a fairly limited operating history as a public company, Zoom has a lot to do to prove and innovate and justify its current valuation. So what are your thoughts on Zoom? We'd love to hear your opinions in the comments section below. We don't own Zoom in client portfolios, but you can request a complete list of all the securities recommended by YCG in the last 12 months by reaching out to us. Thanks for joining us today. Check out one of our other videos and we'll see you next time. Thanks for watching.